This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 345. QE and the Bond Bubble.
We need now to work double hard to overturn.
On the inflation rate and the unemployment rate. It's called the Phillips curve.
The government is too big, it's too intrusive, it restricts what we can do.
My colleagues and I are acutely aware that high inflation imposes significant hardship.
This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
Well, remember how Silicon Valley Bank collapsed in the US because although it had bought government bonds with the money its customers had deposited, those bonds went down in value, so there was a gap between the money held and the money deposited. They were insolvent, in other words, even though they had bought supposedly the safest financial instrument on earth, US Treasuries, US government bonds. So, did they buy when there was a bond bubble? Over the last 10 years, that's what we've seen, and it was set to burst, just like shares. QE. Is it behind all of this? QE and the bond bubble. That's this week on the Debunking Economics Podcast. Now, bond prices have been coming down in price. That's why yields are so much higher. But they're coming back from a high when yields were low. So this week, first of all, we'll begin by sorting out that relationship between bond prices and yields. And then we're going to ask what's all this volatility that's causing all of this? And have central banks got anything to do with this? Spoiler alert, yes, of course they have. But first of all, this inverse relationship between, just so we know we're all on the same page, this inverse relationship between bond prices and yields. Who wants to explain that? Do you want to do it or shall I do it?
You have a crack. My voice is cracking a bit.
Well, let's look at the idea that you've got $100 worth of bonds and they've got they pay 10% interest. They've got 10% coupon rate. So when the government issues it, they say, right, $100 we'll pay. We're very generous, just because my math isn't very good. We'll pay you 10%
every year,
interest every year. Yeah. But then somewhere along the line, you sell it, you can't get $100 for it because there's not the same demand for those bonds. And of course, with bonds, there's a whole load of factors. It is a complicated trading environment because they've got different durations, they've got different lengths of
different issuers,
and of course, in a competitive market where there's so many other assets. So rather than, even though I paid $100 for it, I can only sell it for $90. But the coupon is still $10.
Yeah.
So rather than being 10%, it's going to be a little over 11.1%. So that's why. So that happens all the time.
That's an automatic mechanism.
So bond yields, and so people look and say, well, okay, what's the yield on these bonds? And there's people are trading based on the yield, which is really trading based on the price. And those yields also obviously influence things like interest rates. Very hard for the government to say interest rates or central banks to talk about interest rates being at a particular price if the market is trading bonds with the yields a million miles away from where they want to control interest rates. So in a way, the market is also controlling the ability for central banks to do what they want to do. So
not really. This is one area where MMT is very important. We'll come back to that, though.
All right, okay. Well, explain why.
Well, see, because if you look at how are bonds bought, okay, and the MMT point is that when a government runs a deficit, it has to cover that with bond issues, and it also issues bonds for outstanding interest payments as well. So that when it runs a deficit and it pays interest on existing bonds, it puts money in people's deposit accounts, whether that's individuals in the non-bank sector or non-bank financial institutions or the banks themselves. The three potential locations that the money can go into. They also they have to, in accounting sense, put exactly the same amount in reserves. So the reserves go up. Now, if the reserves are, for example, offering zero interest, which is what they historically did until the financial crisis in 2008, then you got money in your bank which is getting no interest. You're still an asset which is not earning income. Now, if the government comes along and says we're going to give you 1% interest on that versus zero, will you take the deal? Yes, you will, even if the rate of inflation is 10%. because it's better to get 1% than
Nothing
zero.
at all.
So in that sense, the government doesn't have to be beholden to the bond market. This is the point which was made when who's the predecessor to Sunak? I've forgotten her name. Truss.
Yeah.
Okay, when Truss came along with her.
Very briefly.
Okay, yeah. The idea was, the bond market's putting up rates. We can't afford it. We're being blackmailed by the bond market. They could have done it. They could have literally offered 1%, because so long as you offered more on bonds than you got on reserves, then those bonds would have been sold in the primary dealer market.
Right.
It's very different.
But it doesn't happen, though, does it? I mean,
no, it doesn't, because this is because bankers and wankers and politicians don't understand the damn monetary system they're in charge of.
Right. And so they believe that they are beholden to.
They believe they are, yeah.
By the market.
It sort of helps as well if you happen to be a financial market speculator. What's the current Prime Minister's name?
Rishi Sunak.
You know, I've got to get in touch with Australian comedian Dan Illich. Dan got annoyed by the people marketing my course and my cartoon book recently, so I've got to make an apology to Dan one way. But Dan, back when Australia had the same sort of political instability that England has now, Dan, there used to be
We're getting through every prime minister would last a year at best.
Yeah, okay. Well, Dan did this great joke of there used to be a telephone system. You could ring up the telephone and say, at the third stroke, it will be 12:03 precisely.
Yeah.
So he has at the third stroke, the Prime Minister of Australia will be. And I paid $500 for that as a joke to go on his podcast. So you could do it for you could do it for the British right now. So Dan, you need to change it across from the Australian Prime Minister to the British Prime Minister.
Yeah, exactly.
So he's called Sunak, isn't he?
Yeah, Rishi Sunak. I'm sure he has a lot of money invested in bonds, and very interested. But look, there has been a lot of volatility in the bond market, so it was always the safe bet, wasn't it? I mean, it was, if you've got a portfolio and your portfolio manager says, well, do you want to go on a low risk or high risk? I mean, it's basically, if you say high
bonds
risk
versus shares.
Yeah, exactly. Yeah. So I don't have a big portfolio, but I do have a portfolio manager, and I had that conversation. And he says, well, you're very lucky you chose the high risk, because the low risk one
fell in value.
Yeah, well, I mean, they both fell in value, but the low risk one fell more.
This is actually a curious thing about this last period. I mean, I'm not following the stock market anything like I used to because of my work on climate change now. But this was, I think, the first time in history that you had bonds falling in value and shares falling in value.
Yeah.
So normally one goes down, the other will go up. That's the sort of portfolio balancing nonsense that has dominated financial advisors ever since.
I know it's been a crazy topsy-turvy world in that sense. So 10-year Treasury yields in 1990 were up over 8%. They have been progressively lowering. So bond prices have been going up, in other words, for the reason we've explained, while yields go down. So they went down to 1.5% in February 2020. Before the pandemic, I mean, there were ups and downs, but the trend was downward in yields. So we saw bond prices going up progressively.
And I actually bought bonds on that basis in 1993.
Right, knowing that they would
but gambling on my knowledge of Minsky's financial instability hypothesis, that with rising private debt, the central bank would be forced into lower interest rates without actually even knowing why that was happening. And so bond prices are likely to rise.
Right.
I should have bought property, okay? Because they pumped up property far more than they pumped up bond prices. My then wife wanted me to buy property, and I said no. I refused to ride a bubble in 1994. But I did. She said, what will you buy? And I said, I'll buy bonds. So we bought $200,000 worth of government bonds.
Is this how you get through wives?
Huh?
Is this how you get through? What? How many wives have you had now?
Only 3.
Just the 3.
Yeah.
So is it a common pattern? You get in there and she says, "Let's buy a house," and go, "No, it's I refuse to buy a bubble."
No, it was only one. That was a one-off.
I could see how that could end a relationship, though.
It did work pretty well.
She wants the house, and you're
I won't say who walked out the door, but it wasn't the usual story.
So look, this rising in bond prices over that decade, then.
Mm-hmm.
So let's get back to this, though.
I'm having a bit of fun here.
Well, okay. Let's just talk about Steve Keen's love life for the next 20 minutes.
That's enough of all that. Now back to the finance. Okay.
So we've seen bond prices over that period since 1990 just progressively going up and up. So what's been the cause?
Well, fundamentally, the cause has been rising private debt. And this is why I say, again, you've got people in charge of the monetary system who don't understand the monetary system. Because if you go back to government policy like Federal Reserve interest rate setting during the days of Volcker, for example, rate rises were one and often. I think there was actually a couple of 2% increases in interest rates under Volcker.
Yeah.
Now, why could that trashed the economy? We had the Volcker recession, which ended inflation by crushing the economy and crushing trade unions.
Talked about very fondly, though, by those people, the very same people who are trying to crush the economies globally now. So if only we could be as bold as Volcker was.
Yeah. But what he did was, what he thought he was readjusting was inflationary expectations. That was the Milton Friedman nonsense he was following. What it did was crush the economy instead, and then, of course, inflation went down with it. So a large part of why they can't put the rates up now is because a 1 or 2% increase in interest rates on a monthly basis. So the meetings to set the rates were every month. So you could potentially expect your rates to go up 1% increase every month for several months. That would bankrupt people on a grand scale. The break is much, much bigger if the scale of the debt that you're putting the interest rate up on is that much higher.
Yeah,
and that's what it was under Volcker.
Just because you're talking about a bigger percentage, bigger slice of people's income that's being spent to
So
support
now
them.
we talk about a 25 basis point change. Well, it used to be 100 basis points. We only invented the term basis point to cover the fact that we'd had interest rate changes of less than 1%, and what was actually going on was rising private debt. So the bang they got out of an interest rate rise was much bigger than they expected, and so ultimately they came down to 1.25% changes rather than the 1% of the olden days. So the falling interest rates.
We've been having a few 50 basis point. We've been having a few 50 basis point rises lately.
You watch what happens till they try 100 basis points. But yeah, so fundamentally the falling interest rates have been driven by rising private debt.
Right.
And again, this is yet again the causal role of private debt in the economy, which mainstream economists haven't got an effing clue about.
Right.
I was going to say fucking, but I thought you might ban it from the...
You don't know. I hope no one from Apple is listening. Just go into more detail on that then, just so step by step. So we've got more debt.
Yeah,
we're carrying more debt. So to explain to that why
this again is the importance of credit in a capitalist economy.
Yeah.
Again, this is something which I did the very first mathematics on it, I think in 2017. Showing mathematically that credit is part of aggregate demand and income, because the mindset with neoclassicals have is that the loanable funds model is that a bank lending money is really a bank enabling Phil to lend Steve some money and charging the introduction fee. I call that the Ashley Madison theory of banking, for those who know what Ashley Madison is there for. And no, I haven't done that on my sex life. So, but anyway, so. If the bank's an intermediary like that, if Phil's bank account falls and Steve's rises, one compensates the other, and there's no particular impact upon aggregate demand. That's the fictional world that mainstream economists live in, and that's why they think the level of private debt doesn't matter. And when you do the mathematics on that and you model it, if you lived in a world where banks were introduction agencies, then a rising level of private debt would have no impact on no necessary impact upon GDP. Now, the world we actually live in is where banks originate debt and money. So I call that bank originated money and debt, or bombed. So in that situation, the money is created by the bank. The assets go up, which is the debt. Their liabilities go up, which is money. They've created money. The person who's borrowed the money has done it for the purposes of spending. So that credit band becomes part of aggregate demand and income. Okay, so that's what the mainstream is not aware of. Now, what it means is when you put up interest rates, you are likely to affect people's willingness to borrow. You therefore reduce credit, so you reduce aggregate demand. That's the real mechanism by which interest rate rises moderate demand, by changing credit demand.
Right, but how does that demand then translate into this fact that we've seen the price of bonds increasing so much over this couple of decades?
Well, the most recent one, that's the total curly. I mean, the falling trend was driven by rising private debt. When we got this inflationary surge, that's coming from a range of factors. I haven't done careful work on this myself, but the main elements I identified in a sort of casual way, given my own understanding, is first of all the impact of COVID on supply chains.
Yeah, but before COVID, so we've gone from, prices have been going up and yields have been...
Bonds were falling until COVID.
So the yields were falling. But
yields were falling. Bond prices were rising.
Prices were rising. But prices were rising. But yields have gone from 8% down to 1.5%.
Yeah.
So why that gradual decline?
Because, again, of the impact of private debt. Because what the central banks think they're doing is following the Taylor rule. And the Taylor rule tells them that putting interest rates up will reduce inflation. Okay, fundamentally, that's what the rule says. And all vols the number 2 are turning up as an average rate of inflation. I was just say you could reduce neoclassical economics to 3 numbers: a 2% central bank rate of interest, a 3% rate of economic growth, and a 4% rate of inflation. Of inflation. Oh, so 2% inflation, 3% rate of growth, and 4% interest rate. The sort of logic. Now what you've got is what actually sets inflation is markups by firms, cost of production in terms of unit costs, and wage rates. Those 3. Now their models fundamentally come back to saying what we've got is a wage price spiral. So they think wages drive prices. Okay, they don't see that it can also be cost of production driving prices, which are where COVID and energy comes in, and markups by firms. And what gave us this rising inflation in the post-COVID period, well, not post-COVID, but after
after the start of COVID, in this COVID age,
the COVID epoch it may turn into, is the gigantic increase in the money supply. Meant that, and also the fact that some markets no longer existed during COVID. And
sure.
Okay. What that meant was manufacturers producers, retailers saw no problem putting their markups up.
Yeah.
Because they saw no competitive pressure against.
So that all makes sense. But what I'm curious about is this long period before COVID, where we started to see interest rates falling. You're saying, well, that's because central banks were setting interest rates lower, but you've also said that the market and the central banks can operate independently. So, or one is driving.
They thought they were controlling it using minor fluctuations in the interest rate to control inflationary expectations.
Yeah.
What they're actually doing, by putting interest rates up, they hit credit demand. Okay, and they hit it harder than they thought they would, so they'd go in the opposite direction. And if we go back and take a look at what central banks were doing around the financial crisis, they were all putting up interest rates because they expected inflation. Okay? So when we were approaching 2007, in virtually every central bank, we had rising interest rates because what they could see was an inflationary surge coming along. They had no bloody idea a financial crisis was approaching. And I know from speaking to individuals, managers in those central banks, okay, they admit they were completely caught out by it. They had no idea the financial crisis was approaching. They thought they were in controlling inflation. What they were doing was making credit more and more expensive when credit was already starting to top out because of the length of the bubble. So credit suddenly collapsed. You had credit demand in America went from equivalent to 15% of GDP in 2006 to minus 5% in 2000. So in that bang, they dropped rates like a brick. We had the zero interest rate policy for all that length of time. And again, without understanding why, the main thing was that zero interest rate meant the negative credit that we went through and the depressing effect that had on the economy wasn't accentuated by positive interest rates. So they were forced into and they had no idea why they ended up in the zero regime.
Right. Well, okay, I want to explore more about why they did, because it stuck around for a while, and then all of a sudden we seem to have gone the opposite way. I want to look at what the role of QE is in all of this as well, because I'm sure that's a significant part of all of this. Don't answer it yet, because we'll be back in just a second. It's the Debunking Economics podcast. Me and Steve Keen. Thanks for listening. Back in just a second.
This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
Welcome back to the Debunking Economics podcast. We're looking at bond prices and what's been happening really over the last 30 years. I mean, we saw a big change during the global financial crisis. But if we look at from 1990 through to just before the pandemic, yields on bonds have gone from 8% down to 1.5%. We had a period where they were pretty close to zero. So before the break, I was alluding to the fact QE had a bit to do with this, and it did, didn't it?
Oh yeah, QE only came in and after the financial crisis. It was the first country to try it was Japan. The person to create the term was Richard Werner, and what it was done was in the belief that this would increase lending. Okay, and my clearest statement of that expectation is actually with Bernanke in 2009, I think. But you can even find it in Obama's speeches about what QE would achieve. And the whole idea about QE was to buy bonds off the banks and off the non-bank financial institutions.
Which would push the price up, which would bring the yield down.
Yeah, they'd be able to flatten the yield curve across the whole spectrum. So they used to just buy short-term government bonds. Under QE, they bought short and long-term government bonds and private bonds as well, mortgage-backed securities and so on.
Yeah.
So what that was, that drove interest rates down across the board. But the theory that lay behind it was, without having the bonds, the banks would instead have reserves, and they'd lend the reserves out. And you actually find Bernanke saying that if you read the minutes of the Open Market Operation Committee, you'll find them saying that
even though they can't lend out reserves.
They can't lend out reserves unless sovereigns are in cash, which they're not. So this is what's so infuriating about it. So their theory about what bonds would actually do. And my favourite was actually Obama. I'm going to see if I can do an Obama speak here. He said, I think his speech in February 2009.
I'm dreading this already.
I know you're dreading it. Okay, can you do Obama?
No.
You can do Galway.
Yeah, but he's white. There's a bit of a middle-aged white man doing.
Well, I can't. I'll try to do the intonation, if not the. But it said a lot of Americans say, worrying about why the bailout's going to the banks. Where's my bailout? They ask. The truth is that $1 of money in a bank can lead to $8 or $10 of loans by banks, a multiplier effect that will boost the economy more rapidly. That's literally what Paul bloody Obama was sold by Bernanke and friends. It's completely wrong about the nature of banking. But that was the basis of QE. Convert bonds into reserves, drop the yield curve as well, which made it cheap, made the cost of servicing that excessive private debt easier for people. So it did have a minor impact on that front. But the banks can't lend out reserves. What actually happened instead was they were buying bonds off non-bank financial institutions, converting bonds into cash, and what did the NBFIs do but convert the cash back into shares? And that gave us the asset price appreciation.
Right, which we definitely saw. So we saw a big increase in share prices.
My favourite about that particular line, by the way, is that the S&P bottomed at 666.
There is a
mark of the devil.
But there is a multiplier. Not the way he's describing, perhaps. But I mean, if interest rates are lower, then it's easy. It's cheaper for you to borrow. So you might,
but interest rates are often lower because people are less willing to borrow.
Right, yeah.
So it's not a causal factor. That's why, again, one person I'll recommend people read is Blair Fix.
Yeah,
a brilliant Canadian, highly empirical researcher. And Blair's done the numbers recently on interest rates and inflation, and said that inflation, declining or rising inflation drives interest rates, not vice versa. So the causal mechanism that the banks think they have is actually a reactive mechanism.
Right. I completely get that. I think that which negates the argument that, okay, so let's make the cost of borrowing cheaper by us buying up a huge swathe of bonds. So then you can go and invest in a business, and then that will create a multiplier because that business will employ people, and then we'll start to see the economy
that's a fiscal
grow.
Multiplier, not a money multiplier.
Yeah.
So the mistake is believing there's a money multiplier. There is no such thing as a money multiplier, except in economics textbooks. And the best use of those is, depending on how cold it is, a fireplace, maybe a boat anchor. But for Christ's sake, don't read them.
Yeah. But you would get a fiscal multiplier if I was borrowing money from the bank and I was investing it in building a business.
Yeah.
And that's the money that was created. Perhaps
you get an investment boost.
Because the interest rates were lower, I'm more likely to borrow more. But your point is, you're not going to do that if you're not going to see that return.
And this is
because the economy's tanked.
This is again the misinterpretation of Keynes, because what that is arguing is the interest rate is the main determinant of investment. Now, Keynes argued the main determinant of investment is expectations of profit, and they're incredibly volatile. And interest rate is the very, very cumbersome and kludgy way to control it. So the neoclassical papers that talk about the interest rate controlling the level of investment assume rational expectations. And what rational expectations means, capacity for accurate prophecy. So therefore you know what's going to happen in the future, you know the returns, and the only variable is what rate you discount them at. And that's why they come up with this nonsense about interest rates controlling investment.
So in this free market in which we operate, in which there's, only tweaking at the edges, the Bank of England bought, just tweaking at the edges, £875 billion in government bonds. And obviously that's inflated bond prices quite substantially as a result, because they've, which is what they intended.
Yeah.
But this is not tinkering at the edges, is it? This is really controlling the economy right from the centre in a big way. I'm not sure what that is as a percentage of total GDP, but it's not an insignificant sum. £875 billion.
It's a huge sum, yeah. And that's why you see this incredible inflation in reserves for the banks, because when to buy the bonds off them, the way the central bank does it is it credits their reserve accounts. It doesn't put money in their deposit accounts unless you're buying off NBFRs, but it necessarily turns up in the reserve accounts of banks. So that's where this huge inflation in reserves has come from, and it's one reason why banks now get interest on payments on reserves, which they didn't used to get.
Yeah. So it's really has. How do they get out of this? Because they really have screwed up that relationship.
Well, the thing is that this is what they. I called it. I've got to look up my old blog post on debtdeflation.com about this, but I called it a pact with the devil, because if you do QE and then the banks then use, not the banks, the non-banks, the merchant banks, use that increased cash to go and buy shares, then share prices start to rise. So we saw the S&P going from 666 to about 3,000. And then now it's bouncing all over the place. But that meant if they start trying to reverse it, they drive share prices down.
Yeah.
Now, they've become beholden to the belief that they can't have falling asset prices. So that once they start to see asset prices collapsing, particularly the share market, that then raises the possibility that merchant banks, sorry, I didn't get the right intonation there, the merchant banks becoming illiquid again because their assets are falling, their liabilities are remaining constant, they can go bankrupt. So the possibility that the shadow banking system can fail means they try QT for too long, they cause a crash in the asset markets and go back to QE again.
So
a pact with the devil.
Yeah. And if governments have been selling all these bonds and then they've been bought up by central banks through QE, and if the central banks then start to say, well, okay, let's unwind this, let's bring our balance sheet down, let's start selling those bonds on the secondary market.
They cause an asset market crash.
Yeah, so they don't want to do that.
No.
And they also don't want, presumably as well, the government wouldn't want those, a lot of those bonds to find themselves in a third party, because even though that we know that they're going to start paying real money to,
but the real money again is created by the,
which they can create for sure, but they're going to have to pay it to a third party. But I guess if they pay that to a third party, it's money that's being pumped into the economy, so that's a good thing rather than being held by the central bank.
What you're seeing is that's why people are saying about the interest rate rises right now. It's actually increasing the amount of government money being created for the finance sector. Because fundamentally these bonds are bought by non-bank financial institutions, the merchant bankers, and so on. Buying them. So if you put up interest rates, you're increasing the income of the financial sector.
So how do they unwind from this then?
One way is to let the bonds mature.
Yeah.
Okay. Because at the end of a bond, you've got to give the face value back to the buyer.
Yeah.
And then the bond value falls, the value in reserves would rise, value in deposits would rise, and they could do it just by aging the damn things out of existence. And that's what I thought ultimately they'd be forced into doing. But now you have the reversal of this with the rising interest rates. Central banks putting up rates, which therefore reduces bond prices. So.
Yeah.
And we had falling bond prices and falling share prices for quite a while.
Does it matter, though? I mean, if those balance sheets just unwind gradually as they just
it's a gradual thing that matters, because all banks have bad loan provisions. Merchant bankers would have similar allowances. So it's a case of letting the maturity effect come in and reduce it that way.
So, the mix of bonds in the bonds confuse me a lot, actually. I mean, it is a complicated. Bonds are far more. Shares are easy to understand, aren't they? They go up and down. You buy them,
and they don't have an age component to them.
There's
which I think they should.
There's absolutely, yeah, which we've talked about in the past. But there's so many dimensions to bonds because they're driven by a whole load of factors.
Yeah.
But I mean, but the share market tends to get driven a lot by animal spirits, doesn't it? And the bond market less so.
Oh no, there's pretty animal inside there as well. Different breed of animal, but similar sort of thing. I mean,
and how much of that has played into where bonds have been driven then over the last decade?
Well, it used to be the dominant. I mean, it's the biggest financial market by far is the bond market rather than the share market, and that was largely, the bonds were created by the government, but there was no. There was buying and selling pressure, but it was not on the scale of QE. Because what QE meant was the banks, the central bankers are involved in open market operations with the private banks all the time. They're buying bonds and selling them again to try to keep the interest rate within their margin, which back in the days when you had trivial levels of reserves. So the central bank would be partially on the buy side to some extent, and one of my little hypotheses is that the central banks were largely on the buy side to the scale of the interest payments on existing debt, government debt. With QE, they said we're going to be massively on the buy side. Like the American QE when it began was $80 billion per month. So what they were saying is in all the open market operations we do, every month we're going to buy net $80 billion worth of more bonds than we sell. Okay. Now that's a gigantic injection of money into of taking bonds out of circulation and therefore saying, well, if you're going to try to maintain your returns as merchant bankers, what can you do? Well, you've got to buy shares, haven't you? And drive up the price of shares.
Which is essentially why we saw the share prices go out.
Yeah.
But I mean, shares have always been seen as being a risky investment, and bonds have always been seen as being the safe one.
And now all of a sudden they're both dangerous.
Now they're both dangerous. I mean, the only reason, because we've seen this, we're used to asset bubbles being, used as a term for the share market, but we don't tend to think of bond bubbles.
Yeah, but
we've got a bond bubble now.
That's what they've created, yeah.
Created by the central bank.
And it will keep on going.
A bond bubble that's been created not by because of there's so many, because it's a more technical investment. I suspect there would be less likely to see bond bubbles happening.
Yeah, well,
without the central bank having bought however many millions of pounds.
Yeah, so I think this is definitely a consequence of the central banks not understanding the monetary system. Because, again, this might sound ridiculous to anybody who doesn't know what economists do for a living, but their models, the dynamic, stochastic, general equilibrium models, don't have banks or debt or money in them. So they have models of the economy operations which don't include the factors they've got control over. Yeah, which is ridiculous, except for the interest rate, but that's what they do. So they do not understand the monetary system, and yet they're the ones who are in control of it.
Yeah, so there they are trying to moderate the economy and making sure we don't get all of these bubbles, and
they cause them instead.
They caused
the share market bubble, a gigantic one from 2010 to 2020. Now they're causing a bond market bubble.
Yeah, with what was originally seen as being the safest investment you can make, which is the safest investment that people.
Best investment we could make is to shut down every economics department on the planet.
But I mean but there will be people who've got hurt by putting money into investments where they were told it was safe because they're in bonds.
Like bonds, yeah.
And losing out. So last October, the Bank of England, suddenly turned back to QE for a short while, didn't they? 10 billion pounds worth of gilts purchased every day to try and save pension funds from collapsing when we had our previous
Prime Minister, whatever his or her name was.
So
shall remain nameless.
How easily we forget. Yeah. So pension funds presumably were caught out because bond prices were falling. So as those interest rates started to go up. So that was because they didn't have as much collateral, presumably then. So their balance sheets were looking pretty sick because the value of the assets sitting on their balance sheet was going down because bond prices were going down.
And also share prices going down
at the same time. Yeah, but it was the bond market that
because they're big,
the Bank of England was
pension
concerned
funds, they've got to
about.
be conservative, so they've got more so-called safe assets and risky assets, and the safe ones are falling in value.
So there would have been a bit of a guilt, no pun intended, guilt with a U, complex for the Bank of England, because of course they will have driven up the price of those bonds through all of their QE program, and then all of a sudden we start to see the world in this post-COVID epoch.
But now the fun is, what are they going to do because they were still seeing inflation coming in well above their so-called target.
Yeah.
So the odds are they're going to continue putting up rates.
And what happens then? How far do they go? How long do they bang their head against the brick wall?
Possibly indefinitely, but my feeling is we'll see a recession coming out of this. And then when the recession hits...
So it'll be the Volcker 2, isn't it? For exactly the same thing, a recession that is caused by...
government policy.
Pushing up interest rates too far to try and control inflation.
Which is not
they kill the inflation by killing the economy.
Look at Blair Fix's analysis there about how interest rates don't control the rate of inflation. What they can cause is a collapse in credit-based demand. And that's what I'm expecting. We're likely to see if rates go much higher. People's willingness to borrow for houses, willingness to borrow for shares, like the margin loans, will just evaporate, and you'll have credit-based demand collapsing, and then they'll react to an unexpected recession.
And what happens when we come out the other side? I guess we all have short-term memory, so we forget what exactly happened on the way in. But this safe investment in bonds, which is no longer a safe investment because we've seen this bubble, do bonds ever resume their place as the safe investment, or do we start to view bonds as being just as volatile as equities, as shares are?
I think not quite that bad, but I think the days of believing you can actually divide investments into safe and dangerous are over. And this is approaching a long overdue end of the road for the financialisation of the economy.
So we think the only safe thing to do with money is to have it in cash, stick it under the mattress. Is that the ultimate conclusion?
Where my money is. That's all. No, but I think that's we've been sucked into a financialised view of the world. That means being sucked into either bonds or shares, and we had this simplistic idea that bonds were safe and shares were volatile, and that was the investment. That's what investment consultants do. They tell you what's your risk profile, and bang, they'll lean you to one way or the other. That's all they think they have to do. In fact, what we've caused is a financialised. There's too much money in the financial sector, not enough getting to the industrial production side of the economy, not enough to the infrastructure. We've hobbled the real economy, and I would, for one, be glad to see the end of the days of people worrying about bonds and shares in the first place.
Yeah, well, I mean, we worry about it when it's money that we've got to save for our own retirement. And we want to see that money get the best possible return.
I would rather see us getting decent pensions, which is what we had before we did all this nonsense.
Paid for by the government.
Paid for by the government. The government should be creating the money for pensions. And pensioners should be an income source for businesses long after they cease being wage slaves for the same businesses.
Well, that's a very different change from where we are now, isn't it? That's for sure. I don't think that's going to happen, though, Steve.
Well, not deliberately. Like most things in economic policy, it'll happen by accident.
But then we'll also have people saying, well, that's state pensions, that's fine. But, I'm a very wealthy man. I've got I want a much better standard of living than everyone else in my retirement. So
that's easy. Save the money and go and build your own fallout shelters.
Ready for the what follows. The other thing I guess could happen is that if it becomes too risky, even to buy safe assets like bonds, then people are not going to borrow to invest quite so much in these
Hopefully,
assets.
yeah. And less borrowing for speculation would be a damn good change out of all this.
Yeah, because it might just not be worth it. Well, let's see. All right, very good. We'll leave it there for now. We've spoken enough this week. We'll catch you again next week. Thanks, Steve.
Okay, mate. Bye.
The Debunking Economics Podcast.
If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.